Welcome to Future You, a segment to help you take control of your financial future. Today we're talking with Courtney Purl, Risk Insurance Manager at William Buck Chartered Accountants and Advisors, about the importance of risk insurance for younger generations. Welcome, Courtney.
Thanks, Paul.
Courtney, when we're in our 20s and 30s, most of us feel we are bulletproof and there's no need for risk insurance. What would you say to anyone thinking that way?
I would say spend a day in my shoes or any other advisor's shoes, and we probably all wish that we hadn't seen people in their 20s and 30s have a significant health event or an accident occur, but unfortunately we have. And I would question whether if anyone didn't know someone that's actually had a significant event occur, whether it be a young person having cancer, whether it be having a car accident. Most of us would know someone who has. When you look at the cost of one of those events happening, whether it's loss of income, medical bills can be huge. That's really significant. But the thing with insurance is it's there to protect if something actually goes wrong. Because we definitely don't want to be, we never actually want to be using our insurance.
But when we're young and establishing a career and growing a family, money is tight, and many people would argue they can't afford risk insurance.
And I get that all the time. And the thing is, if you're in the position where you can't actually afford insurance, you've probably heard it all before, you actually can't afford not to have it. And I think a lot of people don't realise you can actually fund, especially for younger people, I know we don't like to be paying insurance, but we can fund a fair bit of our insurance through super with our super balance, which does help on cash flow, especially when people in their 20s, 30s, will have families and have mortgages and things that they have to cover. And insurance is the last thing you actually want to incorporate into your cash flow. So you can fund some of your insurance out of super, which is helpful. What I find interesting is that people don't think twice about insuring their car. So it might be you're insuring your car for $30,000. And if you have a car accident, the insurance company will give you money to buy a new car. But then what about if you've had a bad enough car accident that you can actually never walk again and therefore never drive that car again? That cost of you actually never working again is so much more than replacing your car. So what would actually fix that scenario is having income protection. People don't think about those things typically. And if you are a 30-year-old now earning 70 grand a year, that lifetime cost to age 65, if our income stopped tomorrow, is actually over $4.5 million, which is actually really scary. So, the cost of harming us is a lot more than harming a physical possession.
Finally, what would you say to someone who feels the insurance in their super fund is enough for their needs?
What I often find is that cover that's sitting in super is rarely sufficient. So you might have $200,000 of life and TPD cover, but when you look at an average mortgage of $500,000 or $600,000 these days, $200,000 isn't even nowhere near enough to cover that. Another thing with super is that it can take a bit longer to get a claim paid as well. We've handled many claims through super, and it is a bit of a fight to try and do that. So just something that people need to be aware of. And you often find that things like workers' compensation or private health insurance, you will still have costs on top of that. So they're really, those types of insurances aren't going to help maintain your current standard of living.
Thanks, Courtney. To find out more, visit williambuck.com and keep an eye out for the next edition of Future You.